All right, welcome to the Explainer. So right now, as of late November 2025, the market is, well, it's sending some seriously mixed signals. It's almost schizophrenic, really. You've got the professional investors, the smart money, who look like they're panicking. But then on the flip side, there's this new wave of investors betting bigger than ever on a future completely driven by AI. So what gives? How can the market be pulling in two completely different directions at the same time? Who's right? Well, that's what we're going to dig into. We've got a bunch of key charts here that really peel back the layers on this massive split between Wall Street's fear and Main Street's, let's call it optimism. Let's figure out what's really going on. Okay, so first up, let's talk about the most nervous players in the game right now. These are the huge trend-following funds. You might have heard of them. They're called CTAs, which stands for Commodity Trading Advisors. Now, you can think of these funds as like these giant weather vanes for the market. They're so big, they show you which way the wind is blowing. And right now, man, they're spinning completely out of control. And this chart really shows you what I'm talking about. I mean, look at this. It's a total roller coaster. It really captures the sheer panic. Not that long ago, these funds were long, betting on the market to go up by almost $184 billion. Then, bam, they just flipped completely, selling everything and going short $137 billion. And now, they're kind of stuck in the middle. This isn't just regular trading, you know? This is what pure panic looks like. And if you want another sign of the mood out there, look no further than this, the Goldman Sachs Risk Appetite Indicator. It's just fallen flat to zero. But here's the thing. This isn't the calm, everything is fine kind of zero. This is the zero of total indecision. It's like you're flying down the highway at 150 and just slam on the brakes. The whole market has just frozen, completely unsure if it should hit the gas again or just brace for a massive crash. And what's really telling, I think, is where all this caution is focused. It's all in the tech sector, the very engine that's been driving growth all year long. This chart right here shows the largest 4-week capital outflow from tech funds in 4 years. Let that sink in. The professional investors, the so-called smart money, they're not just walking, they are sprinting for the exits. Okay, but here's where the story gets really wild. While the pros are running for the exits, there's another group that's basically setting off fireworks on the deck of the Titanic. This is where that fundamental split in the market becomes absolutely crystal clear. I mean, it's a tale of two investors, for real. On one side, you've got the professionals causing the biggest tech outflow we've seen in 4 years. And on the other side, you have retail investors pouring a record-breaking $239 billion into high-risk leveraged ETFs. We're talking about financial tools designed to amplify every bet. It's like two totally different realities are happening at the exact same time in the exact same market. So what's the dividing line here? What separates these two worlds? It really seems to come down to one thing: your belief in artificial intelligence. For some, it's just a dangerous hype bubble ready to pop. But for others, it's a massive, fundamental revolution that's really just getting started. As one trader wisely put it, the idea is to use AI to boost productivity, not just sell AI as a product. Now, of course, there is a pretty big gap between just talking about something and actually doing it. Get this, 47% of S&P 500 companies are talking about AI's productivity benefits on their earnings calls. But according to the Census Bureau, only about 13% are actually using it. So yeah, companies are talking about AI 3 times more than they're implementing it. But, and this is the important part, that gap, it's finally starting to close. And you might be thinking, hang on, isn't a huge gap between hype and reality the classic sign of a bubble? And you know what? That's a totally fair question. If this were, say, 25 years ago during the dot-com bubble, back then you had these insane valuations backed by, well, not much more than an idea and maybe a cool domain name, zero profit. But the situation today, it is dramatically different. And this next chart shows you exactly why it's so different. This is showing return on equity, basically how good a company is at making money. At the peak of the dot-com bubble, tech companies had an ROE around 15%. And today's tech giants? They're sitting pretty around 30%. These aren't just companies. They are quite literally the most efficient profit-generating machines in history. All right, let's make this more concrete. Take a company like Google. Their AI strategy is it's almost untouchable. They dominate every single layer of the AI stack. I'm talking from their own custom hardware chips, to their massive Google Cloud infrastructure, to the insane amounts of data they have from search, YouTube, and Maps. Then you've got their models like Gemini, and finally, all the apps you and I use every single day. Seriously, what other company even comes close to that?
But these giant companies don't exist in a bubble. So we have to ask what's going on in the wider global economy that's feeding this incredible tug of war between the bears and the bulls.
Well, for one thing, we're starting to see the first, maybe fragile, but still real, signs that the global industrial recession might finally be ending. What you're looking at here are manufacturing PMI indices. It's basically a health check on business activity. And after a pretty long slump, you can see the lines for the US, Sweden, and the Eurozone all starting to tick back up. That suggests a recovery could be on the horizon. There's a catch, though. Investors are paying a very steep price for this potential good news. If you look at US stock valuations, by pretty much any historical measure, they are stretched super thin. We're talking right at the top of their historical range. What that means is that a nearly perfect, flawless future is already baked into the price. So why are investors willing to pay that price? What gives them the confidence to just ignore these huge, blaring warning signs? Well, it looks like an old friend is back in town. The central bank put. It's like this invisible safety net that everyone believes is stretched out right under the market. So here's the basic idea. Lately, when stocks fall, bonds have started to rally. And why is that? It's because investors believe that if the market really starts to crash, central banks are going to swoop in and cut interest rates to save the day. That makes bonds more valuable, which helps cushion the losses from stocks. It's kind of like having an airbag in your car that you just know will deploy in a crash. It makes you feel a lot more comfortable driving just a little bit faster, right? All right, this brings us to the final piece of our puzzle. Let's take a look at investor psychology, but through a really modern lens, to try and understand the sheer conviction behind some of these wild bets. And for that, Bitcoin actually gives us a fascinating case study. The black line here is the price, and that red line, that's the average price that investors paid for their Bitcoin. Now check this out. The price recently dropped right down to that red line. That's the moment of truth, right? That's where all the recent buyers would have started losing money. But instead of a panic sell-off, what happened? They held the line, and the price rebounded hard. It was this powerful collective vote of confidence. So when you boil it all down, what we're really seeing is a massive clash between two incredibly powerful stories. Story number one is all about experience and caution. It's the professionals looking at the historical warning signs and pulling their money back. And story number two, that's all about technology and faith. It's a new generation of investors betting everything on an AI-fueled productivity boom that they believe will make all the old rules totally obsolete. And that, right there, leaves us with the ultimate question, doesn't it? Are these super high prices we're seeing today actually justified by a coming AI productivity explosion, something so big it'll make today's valuations look cheap? Or is the professionals' mass exodus the real siren song that we should all be listening to, warning us that a major crash is just around the corner? If you found this video helpful, be sure to smash that like button and subscribe so you don't miss your next daily edge. More news in our Telegram channel in the first comment. See you next time.